when I published my book, China, the Bubble That Never Pops, back at the start of 2020, I set out a pretty straightforward thesis. China's economy and financial system, I argued, is more resilient than critics in the West give them credit for. And China's economic and financial policymakers are more innovative, more ingenious, better at solving problems than critics here in Washington, DC, or on Wall Street give them credit for. In the last 2 years, of course, a huge amount has happened. COVID has hit China and hit the world. The Common Prosperity Agenda has changed China's corporate landscape. A real estate crisis threatens to tip China into potentially a financial crisis. So what I do in the second edition of my book, which will be published by Oxford University Press in August, and what I want to do today is provide an update and talk about how my thesis on Chinese resilience is standing up in the face of the COVID stress test. So there's a lot we can say here, and I'm going to get into some detail on governance, on finance, on real estate, and on China's international ties in a moment. But before I do that, I want to give a kind of a simple headline assessment of how China and other major economies have performed over the course of the COVID pandemic. So what you can see on this chart is the G20, and on the x-axis, we've got how they've performed on public health during the pandemic. How many COVID deaths have they suffered per million population? And on the y-axis, you can see how they've performed in terms of protecting growth. How big do we expect their GDP to be at the end of 2022 relative to pre-pandemic forecasts? And where's China? Well, you can see them marked out over on the extreme left of the chart. So on public health, China has really performed extremely well during the COVID stress test. Very few deaths in China, certainly very few deaths compared to the large numbers which we've suffered here in the United States and in other major economies. And on growth, well, if we were having this discussion 6 months ago, China would also look really, really strong on growth. In 2020, after controlling their first outbreak, China had a V-shaped recovery. From where we are today, in mid-2022, the picture looks less positive. The Omicron outbreak and the lockdowns in Shanghai, Shenzhen, Beijing, and elsewhere mean that China's second quarter was very weak, and most people expect a slow recovery in the second half of the year. So on growth, China looks less stellar, but compared to major economy peers, well, some are a little bit better, some are a little bit worse, but China certainly isn't standing out on the downside. So that on that first simple assessment of how China has done during the COVID pandemic, how have they done on protecting lives? How have they done on protecting growth? I think the answer is not bad. In a global pandemic, we really can't talk about winners, but China has lost less than most other major economies. So that's the kind of very simple assessment, but let's go beyond that and try and get into a bit more detail. And in particular, let's talk about governance, the financial sector, real estate, and China's international ties. And let's start with governance. Now, Deng Xiaoping is viewed as China's great economic reformer, but he was also something else. He was also China's great governance reformer. In particular, Deng introduced the two-term limit, and that two-term limit has been observed by China's leaders from Jiang Zemin to Hu Jintao, but of course Xi Jinping appears unlikely to observe that two-term limit. He appears very likely to stay on for a third term, and then after that, who knows, maybe a fourth term, maybe he'll stay in power for quite a long time in the future. And that raises a concern. Because when we look around the world at countries where there's a single party state and the leader has stayed in power for a very long time. Think about China under Chairman Mao, think about Russia under Vladimir Putin. What we tend to see is a deterioration in the standard of governance. And when we think about what's happening in China right now, the decision to stick with COVID-0, arguably beyond its useful point, the extremely draconian way in which COVID-0 has been enforced, the failure to secure advanced mRNA vaccines, even though they could do so much to save lives and get the economy opened up again, and the Common Prosperity Agenda, which for all its noble aspirations to increase equality, is certainly going to come at a cost to private sector dynamism and productivity growth. I think we can make a case that that decline in governance standards, which we get when a preeminent leader stays in place for a very long time, well, perhaps there's early signs that that decline in governance standards has already appeared. Now, on the financial sector, this is the chart which kind of has fired the kind of fevered imaginings of a generation of Wall Street China analysts. It's the chart which has sparked fears about an impending financial cataclysm in China. And what it shows is the ratio of outstanding borrowing for the economy as a whole to GDP. And that ratio, of course, has rocketed up from 2008, when it was about 140%, to about 300% today. And when we look around the world and we scan the history books, when we see countries which have this kind of debt to GDP profile, we very often see those countries encountering a financial crisis. Yes, there's elevated stress in the real estate sector, and we'll talk a little bit more about that in a moment. But there's nothing so far which looks like a systemic financial crisis. Why is that? Well, the reason today is the same as the reason when I wrote my book back in 2018, 2019. And that is that financial crises do not start because banks have made too many loans or banks have too many bad loans. Financial crises start because banks run out of funding. Lehman Brothers didn't collapse because they had too much exposure to subprime mortgages. Lehman Brothers collapsed because they could no longer finance their activities by borrowing in the money market. And in China, because China is a nation of savers, and because China's capital account makes it hard for those savings to go overseas, the funding for the banking system remains very, very stable and secure. And what that means is that even though debt has increased a lot, and even though crises like COVID lockdowns damage borrowers' capacity to repay that debt, the trigger for a financial crisis just isn't there.